Hello, everyone. Hope you're all having a great week. Welcome back to another live stream. If you are watching live or watching the recording, feel free to comment where you're watching from. And I'm now streaming in 3 different places. One is on LinkedIn, another is YouTube, and another in a private Facebook group. And if you're not part of the Facebook group, feel free to join. I'll try to remember to talk about that at the end. And today we are talking about RSUs, restricted stock units, which is a form of executive and equity compensation. And let's get right into it. So I hopefully can see your comments if you comment live on one of those 3 platforms, but if I can't, I will check a little bit later. So feel free to ask questions along the way, and let's get right into it. Okay. So how vesting, taxes, and selling really work. So restricted stock units, the most common form of equity compensation. So I've seen this to be the case. It's one of the easier forms of equity compensation that companies can offer to their employees and executives because they are more simple, they're more easy for the company to give. So we're going to go through all the things that matter for you if you have been granted RSUs. They can definitely accelerate your financial plan, but we're going to try to break it down and make it simple for you. For those of you who are watching for the first time, my name is Spencer List. I'm a certified financial planner, and I am a former professional musician. So I spent my entire career playing the saxophones and woodwinds at the highest level, and then I transitioned, and now I'm a holistic financial life planner for music executives and executives just in other industries as well. I am not a big fan of small talk or holidays. I was born 5 minutes before Christmas, so maybe that has something to do with it. And I'm also caffeine free, so if we do get coffee, I won't get it, but you certainly can. Outside of music, I enjoy woodworking, and I grew up playing hockey, so I enjoy following that here and there. I'm an MF Doom superfan, and I'm a husband and father of a newborn. So you might be asking, why is a former professional musician now a financial planner? And it's because of this checking statement almost 10 years ago. Where I came home from a tour with $67 to my name. It was a huge wake-up call for me financially, and I felt vulnerable and scared. I had worked my whole life and career to live this dream, and I was living it, but also there were some downsides to the way I was doing it and my relationship with money, and so I never wanted to feel that way again, and I never wanted anyone in the music industry to feel this way. It's normal to struggle and survive. People, in fact, sometimes are even proud of that. And so I wanted to change that not only for myself, but for others in my community. So I started teaching myself everything I could about financial literacy. And I applied everything I learned, and my life actually changed quite drastically in a short amount of time. Within 18 months of this date, I had built up my emergency fund. I started making more money because my relationship with money improved and my mindset. I started saving to a retirement account for the first time. It was a Roth IRA. And I actually bought my first property. So a lot changed in a short amount of time. And so I started teaching everything I learned to my music community. I did a podcast, a newsletter, a blog. I started speaking at schools and conferences. And I even started a coaching program. But that curiosity led me to want to learn financial literacy at a professional level. So I eventually ended up becoming a certified financial planner. And now I run my own firm, Motif Planning for Music Executives, providing comprehensive, holistic financial life planning. So that's the short version of that story. So a disclaimer, anything that we discuss today is purely educational. I don't know your personal situation, so none of this should be construed as personal financial advice or tax advice or investment advice. I'm just going to explain how things work and some things may or may not apply to your situation. So you should consult with a professional, and feel free to ask me questions as well, and I can answer them. But this is all meant to just be educational today. So what are RSUs? So they are a promise from your employer to grant you company stock in the future. So you don't actually own the shares when they grant it to you. They become yours when they vest. So I'll explain what that means shortly. And then once they vest, they are considered income. So the stocks become yours, and then you have to claim the value of that stock as income, right? So instead of getting cash compensation, you are getting stock of your company, okay? And the reason companies do this is because, their salaries, they don't want to continually increase those because that is cash that the company has to give to you, right? That you earn. And instead, it's a lot easier to grant you stock because then there is no cash outflow happening from the company to you. They just give you partial ownership in the company. So it's a cost-effective way compared to bonuses, right? So they're not giving you cash, like I said, they just give you stock. It reduces employee turnover because of the vesting rules, which I'll explain shortly. And it's an incentive for the employees to care about the stock's performance. So there are a lot of psychological factors to equity compensation, whereas a salary, let's say you increase your salary and then another company offers a higher pay. Well, it might be easy to make that decision to switch companies. But if you have RSUs that take 4 years to vest and have the opportunity to rise in value significantly over those years, even more than 4 years, you might think twice about that higher salary because the value of your stocks could potentially be a lot higher. And you might care more about the company you work at. Now, this psychological tactic goes both ways. So you need to remain objective and understand how this fits into your financial plan. And it can really feel like you have golden handcuffs when you have equity compensation where you never leave the company and maybe you overlook some things that are, I've talked to so many people with equity compensation who are just unhappy with their lives and their career and the people they work with, the type of work they're doing, but they are so attached to the value of their equity compensation that they overlook some of those things that anyone from the outside looking in would say, you need to leave, right? So we definitely want to take a look at the psychological aspect and understand what is at play when you do have equity compensation such as RSUs. And one thing you can do is just to remember that this is simply compensation. And there are a lot of decisions you have to make around them, and there's a lot of what ifs. There's a lot of potential upside, but there's also risk as well, right? So it does complicate things, but with a proper plan, you can make decisions that are right for you and your family. So the upsides are there's no cost to you up front, right? You just get the stock, and you get to benefit from company growth. If the company grows and if the stock value increases over time, you benefit from that. So that can be a nice positive. And yeah, substantial payouts if the stock performs well, right? So there is a lot of upside, but with any upside comes potential downside and potential risks. So the downside is that the value of the stock, the day the stocks vest, whether you sell the stock or not, is taxed as income. So you have no control over the timing of your income that is taxed. So if the value shoots up right before it vests, all of a sudden you've got this larger tax bill, but you actually don't have more cash in compensation. You just have higher value stock. And then of course there's risk, right? Not all companies no company lasts forever, but not all companies do well all the time. Even great companies do not have great stock price movements, right? The value of the stock is not directly correlated to the value of the company and how good the company is. And it can also lead to overexposure to your company's stock. So with people who have equity compensation, especially with RSUs, it's really easy for larger and larger percentages of your net worth to be in your company's stock. So we're going to talk about that a little bit more. So with any upside is potential downside. So we want to evaluate all those. And in the end, when I do financial planning with my clients, there's the numbers aspect, there's the emotional aspect, the psychological aspect. There are the personal things that you want to achieve in your life. It's never just a numbers, because there is no right answer really. There are trade-offs that you are deciding between when you are making decisions around equity compensation like RSUs. So in the end, there really is no wrong answer. And then of course, there's going to be hindsight. Whenever you do make a decision, 5 years later, you'll be able to look back and say, oh, what I really should have done was this because the stock ended up doing this. But you don't have a crystal ball, right? So you just have to make the best decisions that you can for you and your family with the information that you have at that time. Okay, so I mentioned the psychology of RSU decisions. So the question I ask all of my clients is, if you were paid the same amount in cash instead of stock, would you turn around and use all of that cash to buy your company's stock? The answer to that question is a guidepost for what to do with your RSUs or any stock options, which we'll talk about in future live streams. So if the answer is no, that's a strong signal that you may not want to hold on to the stocks once they vest. Now you'd have to look at the consequences of doing that and then decide if that's the case. But this is a really good question to ask yourself, because you are answering this every day that you hold stocks that have vested is a day that you answer this question yes. It may not seem like it, like by remaining passive and not making a decision and not doing anything and just letting it sit there, you are actually actively saying yes to this question every day you hold, okay? It's just subconscious, right? And one other thing I mentioned about larger percentages of your net worth being in your company stock, you're already heavily invested in your company. Your salary, your bonus, your benefits, your reputation, and the time you spend, they're already tied up to that company. So adding company stock on top of that is just a recipe for too much concentration in your company. So there are thresholds to consider in terms of the percentage of your net worth where it makes sense to start thinking about selling your vested RSUs. So here's some sample grant language if you get an RSU grant from your company. So this is a sample, like an offer in your offer letter. Sometimes, usually when you get hired, this might be part of the language. You've been granted 4,000 restricted stock units under the company 2025 equity incentive plan. These RSUs will vest in 4 equal annual installments beginning on the 1-year anniversary of the grant date, meaning 1 year after this day that you receive this grant, subject to your continued employment, meaning you have to remain employed for the vesting to continue happening. If you leave or are terminated before these time periods, the unvested stocks go away, okay? So that's part of the incentive to remain working there, part of the golden handcuffs. So you want to review the vesting schedule, when is the grant date, any performance conditions. So sometimes, it's just remaining at the company, working there, but there could be performance factors at play where your company needs to make this much in revenue over the year in order for these stocks to vest for their employees, right? Another incentive that they might apply. I haven't seen that too often, but it is something that could be possible at your company. And then what happens if you leave the company? Do the stocks vest all right then and accelerate? This is something you could potentially negotiate. Do the unvested portions go away? You need to understand all of those details. So common vesting schedules. There are a lot of different ones. I've seen all different kinds of vesting schedules. It depends on the company. And honestly, that could even change at the same company if they make some changes to their plans. These are just some of the common ones I've seen. So a 4-year vesting with a 1-year cliff, meaning after 1 year from the grant date, a quarter or 25% of the stocks you were granted, they vest after 1 year. Okay, so if you got a February 1st of 2025 and you've got 1,000 shares, that means you've got 250 shares that will become yours that you own next February 1st of 2026. And remember, that also means the value of those 250 shares on February 1st, 2026 will be counted as taxable income. And you have to pay tax on that amount, okay? And then in this 4-year vesting with 1-year cliff, the remaining 75% gets paid out either monthly or quarterly. So you'll just get little bits throughout the remaining 3 years. Straight line vesting is another common one where it's equal portions over each year over a set amount of time. So if it was a 4-year straight line, then it would be 25% every year for 4 years, okay? And then performance-based, like I mentioned, if they have specific targets that need to be hit at the company for your stocks to vest, that might be something. One thing to keep in mind here that can get pretty complex is it's common for companies to grant RSUs every year. So in year 1, right when you're hired, you might have, let's use the same example, you have 1,000 shares that vest over 4 years. And let's just use the example that it's straight line. So 250 shares every year for the first 4 years. Really, it's 5, because it's 1 year, then the first 250 vest, and then the next 3 years you get 250 each time on February 1st. What might happen is in your second year, you might get another grant of RSUs. They might grant you another 1,000 shares that have the same stipulations. So they start stacking on each other, right? And they're layered. And so it can get pretty complex to plan for that. It's not as complex with RSUs, but with stock options where the price you can pay for the stock changes for each grant that you get, it can get even more complicated. But you definitely want to plan for the potential for more RSUs granted to you and the potential for more taxable income to be triggered from all these layers. Eventually, if you're at the company for 3 or 4 years and you've had grants happen every year, you're going to have more and more stock hitting at the same time, which is more taxable income that you need to be planning for. So how RSUs are taxed. So we'll use the example of you got 1,000 shares, and when they vested on that February 1st, they were worth $30 per share. That means you will have $30,000 of taxable income added to your total taxable income. And it is treated as ordinary income. Okay, so it's just added to your W-2 income. You'll see that when your company provides your tax form, it will have that amount in there, even though you didn't get $30,000 of cash, right? You got $30,000 worth of stock that now you own on February 1st. Your company will withhold a percentage to cover the taxes. It's usually 22%. Sometimes it's more if it's a lot of stock. There's a threshold where it would bump up the withholding. And a lot of times that 22% is not enough. So you need to do some tax planning around how much to set aside, potentially make quarterly estimated tax payments, or just have enough cash set aside to pay the extra tax because your company did not withhold enough. Okay, so there's some tax planning that needs to happen. Now, we haven't even done anything with the stock yet, right? It's just now yours and you own it. Now you have a decision of whether to hold it or to sell it, and when to sell it if you decide to sell. So if you sell the shares after they vest, that means you've waited. So you got the stocks, they vested February 1st, and then you've decided to sell 6 months later or 18 months later. Any gain from the day they were vested to when you sell is taxed as a capital gain. So if if the stock is vested on February 1st, if you sell it before February 2nd of the next year, it will be taxed at short-term capital gains, which is the same thing as ordinary income. There's really no benefit. It just gets added to your taxable income essentially. If you hold it and sell it February 2nd or later, so a year and a day longer than the vest date, any gain will be taxed as a long-term capital gains, which in most cases is a lower rate, either 0%, 15%, or 20% based on your adjusted gross income. So that is how the taxes work. Let me see if there's any questions really quick. Let me just glance and see if we've got any. I don't think we do. I don't see any yet. Okay, we'll keep going. All right, so here's a case study of someone who has a plan versus not. So this is Jordan. They're promoted to VP. They receive 5,000 RSUs vesting over 4 years. The company's stock price is $40 at grant. And then over the next year, the stock rises to $50. So in the case of not having a plan, the first 1,250 RSUs, they vest at $50, right? Because by the time the stocks have vested 1 year later, the stock price is now 50, right? So that means $62,500 worth of stock is now yours. But that also means $62,500 is added to your taxable income. So taxes are withheld, but you keep the rest, okay? The stock drops to $35 a few months later. So Jordan still owes tax on the $50 per share value, but only has $43,750 in value. And no strategy for diversification or tax planning. With a plan, we model the tax hit ahead of time, and in this case, we elected to sell the shares right when the stock's vested. So what happens is we get 1,250 shares at $50, and we pay the taxes so we sell immediately. Okay, so we've got $62,500 now of cash from the sale of the stock. You pay taxes from the proceeds, or we set aside enough taxes alongside any withholding that happened. And then we use part of that proceeds to build their emergency savings and diversify their investments, right? Because in this case, their net worth, their company stock was getting to be a big part of their net worth, so we want to diversify. And then we avoid the stress. We don't care what the stock does because we've sold it and we're done with it. And then we get to stay on track with long-term goals. So this is a really simplified example, but the outcome is major. So there's a lot to think about when you come up with a solid plan for your RSUs. But I will say that the clients that I've done this with, it can really remove a lot of stress, because when you don't know what to do, when to do it, and what the implications are, and you've got all this other stuff happening in your life on top of it, this is just unnecessary stress, especially when there's a lot of money at stake, right? We want to optimize and be efficient and maximize this opportunity for you and your family. So final thought. So understand how RSUs work, know when they vest and what the tax impact is when they vest, and have a clear strategy of holding or selling the stock. So they can be a powerful wealth building tool, right? I said there's a lot of potential upside, but there is risk as well, okay? So we want to make decisions based on what the stock represents, which is compensation, not just the number of shares you receive, okay? Know when they vest, know the tax impact, have a clear sell strategy before your shares hit your account. I have a checklist that can help you think through your RSUs. If you would like it, just comment RSU and then I'll reply and figure out how to get it to you. Or you can email me, spencer@motifplanning.com, and say, hey, I watched your RSU live stream. I'd love to see that checklist, and I'll just send it to you directly. It just talks through all the different issues you should think about for your restricted stock units, so I'd be happy to send that to you. If you are looking for comprehensive, holistic financial life planning, then I would love to talk with you, see if it's a good fit. I am flat fee, advice only, and holistic. You can go to my website at motifplanning.com, learn more about my services and my fees. It's all transparent and on there. and hopefully very straightforward. And you can schedule a call. We can just talk. I'd love to hear your story. And even if I'm not a good fit, I would love to find someone who is a good fit for you, okay? And let me just double check. I thought maybe I saw a comment. I did not. Okay. But yeah, feel free to schedule a call, and happy to answer all your questions. If you want to connect more, I have a lot of resources, blogs, tools, so many on motifplanning.com, my website. You could follow me at Spencer List, mainly on LinkedIn, but I'm also on YouTube and everywhere else. And then I also have the private Facebook group that you can join. You can email me at spencer@motifplanning.com. Feel free to ask me any questions. And then also, if you subscribe to my newsletter, you can just go to my website, and it's on there right at the bottom. I will automatically, instantly send you, and you confirm your email. I have it set up where it will automatically send you the key 2025 financial numbers you need to know. So that's like contribution limits, tax brackets, like all the important numbers you need to know. So it'll send you that, and then it'll also invite you to the private Facebook group. And then I just send you all kinds of resources, free access to my financial planning software that you can start using. A lot of stuff. I set it up to where it's like 7 days where I'm just sending you a lot of free resources and things to think about. So feel free to sign up to the newsletter. And yeah, so I don't think we have any questions. I will just check one more time. Okay. Well, I will stick around for a second to see if any questions pop up. So I'll just put the outro screen on, and then the recording will be live on YouTube, on LinkedIn, and in the private Facebook group. So feel free to ask questions, especially to those of you if you're watching the recording. Feel free to reach out. I hope this was helpful, and I hope you all have a great rest of your day. Keep thriving.